11, the statement of cash flows. So we've talked about the statement of cash flows a little bit in each chapter, but now we're actually going to take a look at it by itself and how we generate it. The reason we wait until almost the end of the class to do the statement of cash flows is that it's really important to understand the income statement and the balance sheet, because essentially you just from the information in the income statement and the balance sheet, I should be able to create the statement of cash flows. So we have 4 objectives that we need to take care of in this chapter. Identify the purposes of the statement of cash flows. Why do we actually create it? Distinguish between operating, investing, and financing activities. That is how the statement of cash flows is segmented. So we have 3 sections, and we need to understand what goes into each section. Then preparing a statement of cash flows using the indirect method. This is what 99% of the world uses. So if you go work at a company in some business role, or you ever look at a statement of cash flows, you'll often find that it's the indirect method that's used, and we'll talk about what that means. But we will also present the direct method just so that you know what it is. There's a few small companies that probably would do this, but most companies will use the indirect method. So what is the purpose of the statement of cash flows? Well, essentially, we want to figure out cash receipts, cash payments, right? We keep in mind when we do net income, that is based on accrual accounting, not cash accounting. So you could have positive net income, but that doesn't necessarily mean that any cash came in the door, right? For example, what if your company sold some services or stuff on accounts receivable? So your accounts receivable went up, your assets went up, but no cash, right? And ultimately you need cash to pay the bills, to pay your employees. Just like an income statement, a statement of cash flows will cover a span of time. So it's a month of time, a quarter, a year. What are we trying to get out of a statement of cash flow? What are the purposes? Well, we can predict future cash flows. As you move up in the world of business and finance, you're going to see that cash flows are a very key metric of any company, how we value a company and how we evaluate it. We can use cash flows to evaluate any management decisions, like decisions to invest in property, plant, and equipment. We can look at the statement of cash flows and figure out if we invest in this company or we lend them money, can they pay dividends or can they pay interest, right? We would like our dividends and interest to be paid in cash. Will they have the cash available to do so? And this also links net income to cash flows, right? So remember, again, net income is based on accrual accounting. So net income is not the same thing as cash flows. So again, we have the balance sheet in a point in time, in this case, December 31st, 2017. Some activity happens during the year. We show that on the income statement, and now we also have the statement of cash flows to show that on. And then that activity will update some accounts on the balance sheet. So at the end of the period, we'll have an updated balance sheet, December 31st, 2018. So that's kind of how the timing goes. So let's look at operating, investing, and financing activities. So this is how the statement of cash flows is broken up. We have 3 sections: operating, investing, and financing. So operating activities are things that create revenues or expenses, gains, losses, essentially things that are that happen that affect net income, right? Investing activities you can think of as any activities that increase or decrease long-term assets. So think about purchasing property, plant, and equipment, purchasing long-term investments or investments, right? Selling property, plant, and equipment, selling investments. And then the third section is financing activities. So this is talking about long-term liabilities, mainly things like bonds, right? Or long-term loans. And owner's equity, so common stock, treasury stock, preferred stock, dividends, things like that, right? So all of those sorts of things you'll generally find in the financing section. So here's a visual. Again, this is just looking at your balance sheet. So you have your total assets here. And then you have your liabilities plus stockholders' equity over here. And we can segment those even further, and it shows you current liabilities and current assets are going to affect your operating cash flows. Your long-term assets, transactions with those are going to affect your investing cash flows. And your long-term liabilities and stockholders' equity, that's going to affect your financing cash flows. So again, 3 sections: financing, operating, investing. So as we said earlier, there's 2 formats for the operating activities of the financials, of the statement of cash flows. There's the indirect method. What that does is it starts with net income, and then it adjusts net income for non-cash things to get us to net cash provided from operating activities. The direct method would simply calculate all the cash coming in and all the cash going out that is related to operating activities. So let's look at a very, very basic example. So in the indirect method, we start with net income. Remember, this is an accrual number. One of the accrual figures in here is depreciation. So assuming this was the only thing that happened during this period was depreciation, so this depreciation of $300 decreased net income. So net income, instead of being $900, was $600. But this depreciation has no cash effect, right? This is just an accounting gimmick like we talked about back in the depreciation chapter. So we need to add this back, and it gives us the net cash provided by operating activities of $900. The direct method would simply look and say, well, we collected from customers $2,000, we paid to suppliers, employees, etc., $1,100. So the cash was provided for operating activities, cash provided was $900. It's really important to notice these are the same no matter which method you use. You'll come to the same conclusion. It's just which way you're going. You're either kind of going through the indirect route or the direct route here. And the indirect method and direct method only apply to operating activities, okay? So investing activities and financing activities are going to be the same whether you use the indirect method or the direct method. So let's prepare a statement of cash flows using the indirect method. So here is the template of what we do when we create a statement of cash flows using the indirect method. Honestly, walking through this isn't going to make a whole lot of sense at first. Take a look at this and try and think of why we're making these adjustments. So we're starting at net income. The first thing it's having you do is add back any depreciation, depletion, or amortization expense. Why? Because that was a non-cash event, right? So we subtracted depreciation, amortization, or depletion expense to arrive at net income, but there was no cash affected. So we want to back that out, that expense, put it back into net income so that we can get to net cash, right? This is the path. We're trying to do this like one of those puzzles that you're trying to walk through and figure out how to get from one end to the other. Well, we're trying to get from net income to net cash. And this is what we have to do. We add back any loss on sale of long-term assets, right? We subtract any gain on sale of long-term assets. Why? Well, remember back to the chapter on long-term assets. How was it that we showed a loss or a gain? What was it based on? It was based on the amount we sold the assets for or disposed of them and how that compares to our book value. But our book value was just our historical cost less accumulated depreciation. So again, all of these are just numbers from accounting. There really isn't a cash effect. The cash effect is you sold a long-term asset, somebody gave you cash for the sale of that long-term asset. But where does that go? That goes for investing activities. Because remember, selling and purchasing of property, plant, and equipment goes under investing activities. And that's where we have this. You add sale of long-term assets. I sold an investment or land or building or equipment, right? I sold those things. Cash came into the firm. So I have a positive cash flow, right? I bought long-term assets. I have a negative cash flow, and on and on. So go through, especially this is the section right here, the operating section that most people struggle with. It just takes some time to get comfortable with this. So for now, I would suggest just looking through this and learning these rules and applying them. Once you get comfortable with this chapter, you've gone through this lecture, you've read the chapter, you've done the homework, I would really suggest that you go back and try and see if you can better understand why it is that to get from net income to net cash, we would subtract any increases in current assets other than cash, right? So for example, an account receivable. If an account receivable goes up, we're going to subtract that from net income to get to our next net cash. Why is that? Right? Why is that when accounts receivable goes up? Well, because if accounts receivable went up by 5, we probably had some sort of revenue. Let's call it service revenue by 5, right? So our net income went up by 5, but how much did cash go up by? 0, right? There is no cash here. So the increase in accounts receivable of 5 increased net income by 5, but it didn't increase cash at all. So if we start at net income here, we're going to have to subtract that 5 as we're going down to net cash. And the same will hold true for these other components. So again, go through this, come back. It's not something you'll probably understand intuitively right away. It takes time to grasp this. This is just a visual of what I really just talked about, right? So for things like operating activities, these are the positive items, the things that you will add back to net income, right? So you'll start with net income, add back depreciation and amortization, add back any loss on sale of long-term assets, add back any decrease in current assets other than cash, add back any increases in current liabilities. These are the negative items, right? So if it's a net loss, that'll be negative. This will be a negative from net income to get to net cash. This will, right? And then here you have for investing activities and financing activities. So those of you who learn better with visuals, this might be helpful, right? It's essentially just putting this into a more user-friendly visual. So let's just work through an example to illustrate this, okay? So this is the Red Roadster Superstore. It's a dealer in auto parts for sports cars. We're going to use the comparative 2017-2018 balance sheet and the income statement for 2018, and we'll prepare using the indirect method. And again, I want to emphasize this only affects the operating section of the statement of cash flows. The other two, the financing and investment sections, will be the same whether we use direct or indirect. So let's take a look here. Here's the comparative balance sheets. Some things to notice, for example, right? They took care of it here. They show us which accounts increased or decreased. So we can see cash decreased by $8. The statement of cash flows is going to explain to us how that decrease happened. That's what we're going to get to, right? Is that decrease of $8. But what we're going to do is use these various accounts. So for example, accounts receivable went from 81 to 96. That's a $15 increase. So what are we going to do when we have an increase in a current asset? So let's look at that. And you'll go through that step by step and do that with each section. And here we have the income statement. So we have our sales revenue, our interest revenue, our gain on sale of plant assets, right? So that's one of those things, remember, we're going to have to make an adjustment for, right? Here's another one, depreciation expense, we're going to have to make an adjustment for. And on our statement of on our income statement, we have the net income, and that's what we're going to start off with in the indirect method. So we're going to start off with this 50. So here's just a little bit of a synopsis of what I just talked about. So from the income statement, we're going to take the net income, any of these expenses, any of the gains and losses. From the balance sheets, we're going to look at any increases or decreases in current assets and any increases or decreases in current liabilities. So depreciation, depletion, amortization expenses are going to be added back to net income, which will help us convert net income to cash flow, right? Why? Because there's no effect on cash. Go back and look at the journal entries for depreciation, depletion, and amortization, right? There's no cash journal entry there. And they decrease net income when you do them. So adding that back cancels the deduction on the income statement. So we saw in the earlier exhibit that $18,000 was the depreciation expense. Just as a reminder, there it is right there. So as our starting point, we start with net income, because again, we're doing the indirect method here. So we're starting with net income. We're adding back depreciation, right, from that income statement that I just showed you. Now, any gains or losses on the sale of long-term assets. We're going to adjust net income, subtract any gains, add any losses. Okay, so we know TRRS sold equipment for $62,000. The book value was $54,000. So if you remember back to our chapter on property, plant, and equipment, that would result in a gain of $8,000 showing up on the income statement. But again, there was no cash here. What cash from this transaction came? $62,000 from selling this asset. And where does this go? This goes under investing activities. So we have net income now. We added back the depreciation expense. Now we're going to subtract the gain on sale of plant assets. Why are we subtracting it? Because when we had a gain, that increased our net income, but that didn't change our cash at all. Remember, the cash was the 62 that came from selling the asset, and that's going to go down in the investing sections. So this gain was just on paper. It was just comparing what we sold it for, 62, versus our book value of 54. And that's how the gain showed up in net income. So we're going to get rid of that gain in net income to arrive at net cash. Next step is any changes in current assets and current liabilities. And of course, we're excluding cash because that's what we're trying to figure out is the cash amount. So any non-cash current asset, if we increase a non-cash current asset account, that decreases cash. So in this case, accounts receivable increased by $15,000, prepaid expenses increased by $1,000. These are both assets, current assets that increased, okay? We have a decrease in inventory of $3,000. And a decrease in current assets will increase cash. So let's see how that looks. Oh, and then we're going to also look at the current liabilities. So our current liability, an increase in a current liability increases cash. A decrease in a current liability decreases cash, right? In this case, we had accounts payable increased by $34,000. Salary and wages payable decreased by $2,000, right? Accrued liabilities decreased by $2,000. And hopefully you go back and after you've read the chapter, this starts to make sense. But just to make sure you kind of slowly, intuitively understand this, if we had a salary and wages payable and it decreased by $2,000, so this was a liability, a payable, what did we do? Well, we probably paid $2,000 towards that payable. What did that journal entry look like? Well, salary and wages payable, debit for $2,000. And what did we credit? Cash for $2,000, right? So cash decreased. Sorry, I meant to circle this one, but they both say decreased, but I meant to circle this one. Cash decreased when this payable decreased, right? So that's the journal entry. And hopefully you see the cash effect right there. So we're going to put all of this together. All of the last few slides, we're just putting it into the Excel sheet. We started with net income. We're adding back depreciation. We're subtracting this gain on sale of plant asset. We had an increase in an asset, a current asset, that decreased, we decreased net income to arrive at net cash. We had a decrease in a current asset that increases, we add that back to net income to get to net cash, right? And on and on and on. So increase in prepaid expenses, that's an increase in a current asset, so -1, right? Increase in accounts payable, that's a current liability, so we're increasing that 34. Again, I don't really think you're going to completely absorb this first time around. It takes a while working with the statement of cash flows and especially the indirect method, but take a moment. Pause the video, go back to the book, look at this, or rewind the video and look again at how we build up to this. But as you can see, once we've done all these adjustments, what we get is the net cash provided by operating activities, 77. So we went from the 50 of net income to how much actual cash came in, 77. So you can see net income does not mean the same thing as net cash. You have to figure out what the net cash effect was. Now let's look at investing activities, the next section. Definitely much easier. Investing activities are just things that affect long-term assets. So plant assets, long-term investments. Okay, so if you have an increase of long-term assets, right? So you have more long-term assets this period than last period. Well, that decreases cash. You bought some more property, plant, and equipment, right? If you decrease the amount of long-term assets you have from one period to the next, well, that increases cash. You sold those assets, someone paid you in cash. Now, there's a bunch of different ways, and this is kind of a review. It may not seem like a review. Take a look at these equations. This is basically just evaluating the various T accounts, okay? So again, this will probably not immediately click for you, but if you take some time and work through this, it will probably make sense here, right? So if we look at the plant assets net account, you have your beginning balance. You'll add any plant assets that you bought. You're going to subtract any depreciation expense from that amount, right? Because this is net plant assets. You're going to also, you would subtract the book value of any assets that you sold. That's your X. And you have your ending balance that comes from the balance sheet, the next balance sheet, right? So if you have your beginning balance and your ending balance and all the factors that contributed to the change in your net plant assets. So if you have one unknown here, you can solve for this X. So you can figure out how much in sale of assets you had by just rearranging this equation, and you'll get X equals the book value of assets sold plus any gain minus any loss, right? So again, do your math here on the book value of assets sold, which comes out to 54,000, right? So that's here and here. And then so your sales proceeds can just get figured out by taking that and adding any gain or subtracting any loss. And that gives you what the actual cash sales proceeds were. And if you go back a few slides, that's what it was. We had the book value of 54,000 and we sold it for 62,000, right? All I'm doing there is talking about this. We can look at investments in a similar way. We look at the beginning balance of our investment accounts, how much we purchased in new investments, and the ending balance, right? So it should be 150,000 based on that, but we only have 140,000. So what book value of investments did we sell? 10,000, right? So we sold 10,000 worth of investments. And here it is in the T account version. And here we can do the same thing for notes receivable, right? So we have the beginning balance, any new loans that we made, any collections that we had, and our ending balance. In this case, they kept it simple. We had 0 to begin with. We made 21,000 of new loans. We didn't collect anything. So notes receivable, people owe us 21,000. And that's what these equations up here are. It's really just showing you in algebraic form this analysis of a T account. So now we're moving on. This is the investing activities section, and you can see the acquisition of plant assets decreased cash by 196. We made a loan to another company, so that decreased cash by 21. We sold some plant assets, so that increased our cash by 62. So from our investing activities, we used up 155 of cash. Our operating activities generated 77 of cash. So here is just kind of a synopsis that you can say for how you can analyze the sale of plant assets, the sale of investments, collecting of notes receivable, and for payments, the acquisition of plant assets, the purchase of investments, any new loans that are made. Okay, so you can go here and figure out and look at the equation, and hopefully it'll start making sense over time. I know the first time you're looking at this, believe me, it doesn't make sense. Even to me, it didn't make sense. It took a while, really, until I got into intermediate accounting before it started clicking really well. Finally, we have the cash flow from financing activities. So this looks at your long-term liabilities and stockholders' equity. So let's look at it directly. So one thing is your long-term debt. And how can we figure this out? How can we figure out some of the figures here? Well, we know what our beginning balance is of our long-term debt. How much new debt did we issue? 94. If we didn't pay any debt, how much should we have here? Well, this comes out to 171,000. Right? But we don't have that. We have 160,000. So how much in payments did we make of the debt? 11,000. And so again, you can look at this in a T account form as well. What about issuing stock and purchasing treasury stock? Well, we can look in our common stock account. We have our beginning balance and our ending balance, right? So what happened here? Well, we must have issued new stock of 4,000. For treasury stock, we again have our beginning balance and our ending balance. What happened here? Well, we must have purchased some treasury stock, right? There you go in the T account version. What about dividend declarations and payments? Well, there we have to remember, look at retained earnings, because retained earnings, we have our beginning balance of retained earnings. We add any net income, right? We knew it was 50. So if nothing else happened, our ending balance should be 136,000, but it's not. It's 119,000. So what's the difference? The difference is we paid 17,000 in dividends, right? So we did dividend declarations and payments of 17,000. And so here we go, this section from financing activities and how that looks. Issuing long-term debt, 94. Issuing common stock, 4. Paying long-term debt, we put 11 towards that. Paying dividends, 17. So our cash from financing activities, our cash flow was 70. So in summary, our operations generated 77 of cash, our investing activities used up 155 of cash, and our financing activities generated 70 of cash. When we net everything, overall, our cash decreased by 8. So we started with cash of 42, we ended with cash of 34, right? Our change in cash was 8, and we can explain the change in cash by all of these various factors. And so just to kind of close the loop on that, let's go all the way back to where we started. Right here. This is where we started, right, when we did this section. And here you go. Sure enough, we started with 42 in cash. We ended in 34. The change was the decrease in cash of 8. And so the statement of cash flows explains to us what all the factors were in coming up with the decrease in cash of 8. So let's go all the way back here. So here you go. Here's another kind of summary sheet that talks about, issuing long-term debt, issuing stock, paying long-term debt, purchasing treasury stock, and dividends. So you can look at some of the mathematical equations here. It's kind of just a cheat sheet for you. Obviously, in the real world, you'll have Google, so you can look this stuff up. But as you're doing homework or a quiz or a test, you can have this handy to quickly figure out, how to calculate some of these inputs. There are also some non-cash investing and financing activities. For example, if I acquire a building by issuing common stock, it's non-cash, but it's pretty important for a company to disclose that, right? Or acquiring land by issuing a note payable, or paying long-term debt by issuing common stock. Right? So any of these non-cash investing and financing activities, they don't affect cash, but you do actually still show them on the statement of cash flows. Just at the bottom, you make a note of non-cash investing and financing activities. Or some companies will just make a footnote in the 10K, the financial statements. But you do need to disclose any of these non-cash activities. So let's quickly look at the direct method. Again, this is pretty rarely used. You're almost always going to see in the real world the indirect method. But just so you have a comparison, we'll quickly go through and look at the direct method. So the reality is that the authorities would actually prefer the direct method, right? It's much clearer. You'll see that it's much clearer about the source and use of cash. But the reality is very small percentage of companies will actually use this method. It's going to require more computations than indirect method. Why? Because a lot of the line items on a like collections from customers is not found anywhere on the financial statements. You actually have to do some digging and figuring that out, right? This is super important, and I've said it now, I think 2 or 3 times, but I'm going to say it again. Your investing and financing cash flows do not get affected by the method that you use. Whether it's direct or indirect, your investing and your financing cash flows are the same. And even more importantly, even with your operating cash flow, the change in the cash provided by operations, the bottom line is going to be the same whether you start at net income and use the indirect method or you use the direct method, right? Very important for you to understand that. So in this case, using the direct method, when we look at the operating activities, all we're going to do is, this is why in theory we would really like this method. We're just going to look at all the cash receipts. What was the cash collected from customers? That's a plus. What was the cash from interest and dividends? That's a plus. Any other cash that came in from operations? That's a plus. Did we pay to suppliers, right? Accounts payable with cash? Did we pay with cash to employees? Did we pay with cash any interest and income statement or any other operating expenses? Yes, we did. Okay, those are negatives, right? Very straightforward. This is kind of the way you probably would think about it in your brain. It's, well, how much cash came in directly from my customers and how much cash went out directly to various things I have to pay for. In this case, we won't even see depreciation, depletion, and amortization because they're not going to be listed in the direct method because they don't affect cash, right? And we're not starting with net income in the direct method. We're simply listing out all the cash that comes in and all the cash that went out. We don't have to play with adding back, gains and losses and this and that and all that good stuff. So obviously it makes life easier. Again, investing and financing activities, same as the indirect method. Whether you use direct method or indirect method, investing and financing activities do not change. So here you go. Here's the visual of how it would look, right, in a little Excel spreadsheet, your receipts, your payments, that gives you net cash provided by operating activities. And if you go back to the earlier example, you'll see that the cash flows from investing activities here look the same, right? So this is just a continuation of the earlier slide. If you look at financing activities and investing activities, they look the same. And so this is the visual, like we had earlier, the visual for the indirect method. This is the visual for direct method. The things that will add to cash, the things that are negatives, right? This is just more intuitive, really, the direct method. This gives you a visual of the direct method of computing cash flows from operating activities. Okay, so you'll kind of look at your receipt from customers. We would take the sales revenue and then add or subtract. So add a decrease in accounts receivable, subtract an increase in accounts receivable to sales revenue, and that would give us our receipts from customers. And you have to do all this math. So this is my point earlier. This really represents this point. Let me show you guys. Oops. Right here. Requires more computations than the indirect method because for all of these line items, I need to do these computations, right? I need to take to figure out my payments to suppliers. I need to take costs of goods sold, and I need to add an increase in inventory or subtract a decrease in inventory, right? Which also means adding decreases in accounts payable, subtracting increases in accounts payable. So again, this is probably not going to click right away, but you see you have to do all of these computations in order to figure out my payments to suppliers, to employees, for interest, for income tax. Why? Because this stuff does not show up anywhere on an income statement or a balance sheet or anywhere in the financials. You actually have to calculate it by using items from the income statement and the balance sheet. So this is, again, the Red Roadster Superstore, our income statement, the same one as before. You see net income is 50. The same balance sheet, right? So this is the same thing as before. They're just showing it again, all the different changes. And this is going to show you these computations. So this is basically just walking us through this stuff right here to calculate the numbers. So to calculate the collections from customers, we're going to go to our accounts receivable. We're going to look at the beginning balance. We're going to add any sales, right? So that should give us 384,000. It doesn't. We only have 96,000 in our accounts receivable at the end. So we must have collected 288,000. And so this is saying the same thing as this. So to calculate receipts from customers, we need to take sales revenue and then adjust for the decrease or increase in accounts receivable. So that problem is shown right here. And this is the T account way of looking at it. So take a moment, go back, listen to this again, or pause the video, work through this problem, make sure it kind of clicks, right? Don't just sit there and blindly listen, because you do have to kind of put pencil to paper to slowly start to understand this for it to click. If you're just listening to what I'm saying, it's going to leave your brain in about 30 seconds. So the cash receipts of interest and dividends will appear on the statement of cash flows. So the $2,000 of interest revenue can be found on the income statement. And we see that from the income statement that there was no revenue from dividends for 2016. Here's the different accounts: cost of goods sold, accounts payable. This is doing the math back from this, right? So payments to suppliers, here are the things we need to do. So take this visual and work through this example, okay? To figure out first your purchases and then what you paid for inventory. So how much did you do in purchases, and then how much did you actually pay? You see, you need this number here in order to calculate how much you actually paid in cash for inventory. So go through this example, make sure, go through these numbers, go through this algebra, be comfortable so that you know how the steps that you're having to follow to get to this number. And again, I'm reiterating why the direct method can be challenging, because you have to do all these calculations to actually figure out how much did I make in cash payments for inventory. And this is for other stuff, for other operating expenses, right? For prepaid expenses, how do I calculate it? For accrued liabilities, how do I calculate my payments? So pause the video here and work through these. Make sure these T account analysis makes sense to you, right? For other operating expenses, what do I do? So you can see this is the total here. So this was looking at this 8,000, this 3,000, and this 9,000 that's calculated here. So that's how you get your total 20,000 that was payments for other operating expenses. And here's a visual of how everything flows, right? So just take a moment, let this kind of absorb. So you had prepaid expenses that expired, and that just got funneled into your other operating expenses, the total that you're calculating here, right? That came from prepaid expenses, from accrued liabilities, all that good stuff, okay? Payments to employees. We look at the liability, salary and wage payable. What was the beginning balance? How much did we have in salary and wage expense? So it should show us that we owe employees $62,000, but it shows us we only owe them $4,000. How much have we paid them? $58,000, right? And here it is in a T account. So here goes a list of operating activities that would normally happen in a business, and all of the ones that have an asterisk here, you'll see that that indicates that a cash flow is going to be reported on the statement of cash flows. So this is all of their transactions. This is the summary of the 2018 transactions for this company. Key thing here, you'll see that the operating activities section is different now than the indirect method, right? You'll see these numbers are different. Go look at the indirect method and look here at the direct method. But your net cash provided by operating activities is 77, just like when we use the indirect method. So you will arrive at the same number, you're just taking a different road to get there. So here were some listed investing activities and financing activities. And the key thing here is that your investing activities and your financing activities are going to look the same whether you use the indirect method or the direct method. And your conclusion is going to look the same. Your cash started at 42, ended at 34, it decreased by 8. And again, we're going to show these non-cash investing and financing activities at the very bottom. It's going to just be for informational purposes for people who use your financials and your statement of cash flows. So one of the key things that you're going to take away from this chapter into your future classes, especially corporate finance and various finance classes, is what is the free cash flow? The free cash flow for a company means looking at the cash that gets provided by operating activities. So in your operations as a company, how much cash are you generating? But then subtract any cash that you have to earmark for purchasing property, plant, and equipment. Anything that's left is your free cash flow. You can use it to pay dividends. You can use it to buy back stock. You can use it to, invest in more employees, whatever the case may be. But that is a huge and very useful number here, free cash flow for any company. Because if you don't have a lot of free cash flow, you probably can't take advantage of opportunities and expand your operations. So that is the statement of cash flows. Again, the indirect method is the one you really need to study and come away from. The direct method is good to know, and you should understand it, but it's really the indirect method that by far is the most important factor. So that's the statement of cash flows. That's all we cover in this class. You will go deeper into it in future finance and accounting classes. And it is a very, very important statement because cash drives so many things when you move on in finance and accounting and business. So good luck, do the homework, and feel free to come to the lab to get some tutoring help or come to my office hours or ping me with questions.